Hello students and welcome to this discussion on part 1 of US CMA. We shall be discussing a part of section A. Section A is financial reporting decisions and accounts for 15% of the total marks of part 1. But in this module we will be discussing only revenue recognition. One part of financial reporting decisions was financial statements, which we've already discussed in another module. Now we are discussing a part of recognition, measurement, valuation and disclosure. In this module, we'll be discussing revenue recognition. So, what do you understand by revenue recognition? Let's break it up. What is revenue? You know what is revenue? Revenue is nothing but the gross income which is earned by any enterprise from their day-to-day business activities. So can I say simply maybe it means sale of goods and sale of services. That is revenue. So what is recognition? What do you mean by recognition? Recognition is nothing but recording it in the books of account. So revenue recognition is nothing but the recording of sale of goods and services in the financial statements. So we will begin with revenue recognition as per the Accounting Standards Codification 606. Right, this is new codification. The US GAAP is based on this codification, and for revenue recognition, they tried to make a uniform policy. So you don't have an IAS 18 and IAS 11 recognition of revenue and construction contracts. They've all been merged into one, which is represented by the ASC 606. I'm sorry, IAS etc. was we were talking about IFRS, but in the US GAAP also there were separate standards, but they've all now been merged into forming the ASC 606. So we'll understand there is a 5-step process. We will go through what is the 5-step process for revenue recognition here, and thereafter we will look at the accounting. Having understood the process, we will look at the accounting treatment. A couple of examples and the accounting treatment. Then we will move on to revenue recognition for long term. That is when they are spread over a period of time, more than a year, etc. The contract remains the same, revenue recognition remains the same, but you might have to look at some of the accounting entries because it is over a period. So there is a small difference there. So we will look at that. Next, that would form the chunk of our discussion. Small section on returns. When you sell something, there could be returns. So how do you account for these returns? Usually, these returns, when we account for them, we make what is expected to be collected. So recognition is based on what is expected to be collected, and based on that, we may frame the entries. Quick note on consignment. After consignment is a principal-agent relationship, and therefore, when a principal sends goods to the consignee to sell, those goods continue to belong to the principal, to the seller, and they do not belong to the consignee. Just to underline that fact. And maybe you're already aware the matching concept. Whenever you recognize revenue, the expenses which were incurred in order to recognize the revenue should also be recognized. So match the expenses and the revenue. Okay. In between, we will have a couple of quizzes, slightly longer quizzes, so that to test your understanding of what we have done. And we will wind up with a brief recap of all that we are covering under revenue recognition. Okay, students. So let's begin. And let us move on and understand the rules to recognize revenue. What is so difficult? What are the rules to recognize revenue? Suppose I go to the grocer, I buy vegetables, I pay him cash. It is sales for the grocer, as simple as that. I have bought vegetables and he will record it as sales. So is there something, what do we mean by rules to recognize revenue? Let me explain this to you through a short story of 4 confused people. 4 Four people A, B, C and D have the following discussion. Let us begin with first Mr. A, who is an ice cream vendor. He sells ice cream on credit. He goes from door to door and sells ice cream, collects cash. Sometimes he puts his little cart in the park. People come to him and buy ice cream. It is normally on cash and there is no problem. But he says, you know what, I have a particular household where I sell say 5 to 10 ice creams nearly every alternate day. I do not collect change from them every day. What I do is at the end of the month, I give them the bill. See, in the beginning, I give them a bill for the month and they pay me by the first week of the next month. So my question is, the sales that I have made in December, I gave them a bill in 1st January and they will make payment to me by the 6th or 7th of January. So the sales which I make in December, since I have not got the money, should these sales be considered as December sales or should it be considered as January sales? So this is Mr. A's confusion. So Mr. B tells him, are you sure you'll get the money? He says, oh, positive. I go there every day. I have never had a problem with them. Even if I bill them for more ice creams, I'm sure they would not ask. That is the kind of relation we have with them. I will absolutely get the money. So B says, oh, you are lucky. My problem is different. You know what has happened today? Today a customer has walked in and she has bought a TV from my store. She made a payment of $1,000 and the balance $4,000 she has promised to pay in 4 quarterly installments. Now somehow I have a feeling that she may not pay up all her installments. I was under pressure to make this sale. Now my question is, I have got $1,000 on 28th of December. The remaining $4,000 I do not know whether I will get or not. Should I take 5,000 as the sales? Should I take 1,000 as the sales? Or should I not book any sales at all? What do I do? This is Mr. B's confusion because he has a problem with his customer. He does not believe that she is going to pay. He is a bit doubtful that she will pay all the installments. But Mr. C says, oh, well, you have at least sold it. The customer has taken your goods. I want to book sales before. Book sales before? What does that mean? He says, look, I've got a contract. My customer has asked me to make 1,000 units of this product. The price has been settled. And I have finished manufacturing these goods on 29 December. However, my customer will be able to collect these goods only on 5th of January. I want to record the sales now because these are not my goods. These goods I have made, these goods which are lying with me have been made particularly at the customer's instruction. These are his goods and therefore on 29th December I want to book these sales. I do not think these should be sales of January. Mr. D says, haha, I have a much greater problem than all of you. You know what I do? I have a contract for $1 million, but it is to build a bridge. And mind you, it will take me 5 years. What do I do now? 5 years I'll be incurring costs and of course my customer will be making part payments to me too. How do I recognize this revenue? Do I recognize $1 million at the end of 5 years or do I recognize some amount every year? If I recognize some amount every year, what is the amount that I should recognize? You realize the confusions of the 4 people.